The last two videos covered black swans, risk, and structural failures in how we deal with them both biologically and mathematically. This leads directly here, the point Taleb is really making. Risk isn't something to fear, risk is something you should position yourself to benefit from. But this doesn't happen by accident. To benefit from risk, you have to structure your life decisions and exposures in finance in a very specific way, one that respects three brutal truths. 1. Humans, including you, are bad at predicting the future. 2. Outcomes are asymmetric, losses and gains don't scale evenly. And number 3, most systems are non-linear. Taleb's response is to understand convexity, avoid concavity, use the barbell strategy, and stay out the middle. So what does all of this mean? At the heart of Taleb's thinking lies the concept of convexity versus concavity, borrowed from mathematics but applied in finance. In simpler terms, a convex payoff means you gain more than you lose from randomness in a trade. A concave payoff means you lose more than you gain from randomness in a particular trade. Convex refers to a payoff structure where the upside is disproportionately large relative to the downside. A classic finance example is a call option. A call option offers limited downside, which is the premium paid, but theoretically unlimited upside. The more uncertainty or volatility in the market, the more valuable this option becomes. Concavity, on the other hand, describes situations where the downside is disproportionately large relative to the upside. This is the domain of hidden fragility. An example of finance would be excessive leverage. It can slightly increase returns in stable times, but it can create the potential for massive losses when volatility returns, especially when we can't pay off debt. To benefit from risk, one must tilt themselves towards convex opportunities and away from concave opportunities. This is not simply just being aggressive or taking on more risk, it's about the type of risk one engages with. Systems and strategies built with convexity in mind improve with this order. Those built with concavity collapse under it. The best way that we can describe financial applications of convexity and concavity is options trading. Long volatility strategies such as buying puts or calls are inherently convex. They lose small amounts in most scenarios because you have to pay the premium to get the options contract, but you can yield high returns in outlier events when the options are actually inside the money. Venture capital is also very interesting. The venture capital model or VC model is inherently convex. Most investments fail or break even because most startups fail, but the few winners, such as investing in Microsoft or Google early on, can return many multiples, basically compensating for the rest of the costs. Or even insurance actually. Selling insurance, for example, like catastrophe bonds, is often concave. If we look at the opposite side here, it provides steady income in selling insurance, but it contains tail risks that can wipe out gains from other people and more. For instance, you're selling insurance for a car. Most people won't get into car crashes, but the few who do, and especially those who have many problems with their car or their car is very, very expensive, that sort of catastrophic event can wipe out most of the earnings you get from insurance. Convexity is what allows something to gain from disorder. Taleb calls this quality anti-fragility, not just robustness, resisting shocks or being indifferent to randomness, but improvement because of randomness or risk. Think of muscle growth, for example. Lifting heavy weights, which is a stressor to your body, it causes tiny tears and actually hurts your body slightly, but the body overcompensates by making the muscle stronger over time to resist this pressure. It's called anti-fragility, and your body becomes stronger because of it. Taleb's barbell strategy is a practical application of the convexity principle. Instead of taking a moderate middle-of-the-road risk, Taleb advocates for a mixed strategy. Combine extreme safety with high-risk, high-reward opportunities. On the one end of the barbell is the maximum safety. Cash, T-bills, gold, index funds, other assets with little or no risk of ruin. On the other end is the place with maximum upside. Options, venture investment, tech stocks. The middle, Taleb warns, is where most hidden risk lies. The strategy ensures that while majority of one's capital is protected, which is maybe 90% in safe stocks or in safe securities, a smaller portion is exposed to potential massive upside. The key is that the risky portion is not just high risk, but also high reward. The barbell makes it so that the safe stocks compensate for the downside of the high risk area, meaning that it is convex even if you stand a lot to lose from crypto or from options. This can happen in the portfolio level, in hedge fund level, and also in the personal finance level. For example, in portfolio construction, you could put in government safe bonds and of course crypto, emerging tech, and options in 10 to 20%. Hedge funds naturally do this in their own portfolios as well. I think the most interesting part is in personal finance actually, where in personal finance you could use index funds or gold or T-bills, low yield but protects your inflation while going for tech stocks or options. This can be applied to multiple levels. One of Taleb's most contrarian insights is his disdain for the middle. Moderate risk, moderate return strategies that appear safe but are actually vulnerable to black swan events. In finance, this often translates to strategies that offer daily returns or stay steady returns until they blow up. This is especially true in institutional finance. The shining example of this is LTCM, long-term capital management, where they often use steady gains while taking on risks that look conservative. But by doing a black swan event, of course, their hedge funds failed.